PayPal is a company that has been really trendy in the past few months, and this is exactly why. It is a company that has and has had solid fundamentals for a long time. However, its stock has had troubled performance. Just look at this chart from June 2020 up to now, December 2023. Just look at how the PE ratio has evolved. It used to trade at a PE ratio of around 80, and in only the time span of 3 years, it is currently trading at a PE ratio of around 18 or 20. Just look at the price evolution. And it's not about the EPS, because the earnings per share are higher than what they used to be in June 2020. But this has returned minus 30% in the past 5 years, despite having solid growth and having low debt. So I decided to look further into it, and I did an analysis. It has a solid balance sheet, it can cover its interest payments, it has growth, stable margins. So why is this happening? I actually saw one indicator which caused me to not want to invest in this stock, and we'll speak about it later. But first, let's deep dive into the stock. So PayPal, is it a diamond in the rough? PayPal is a digital payments platform that enables online transactions, and it provides a secure and convenient way for users to send and receive money globally. It also facilitates the online payments and money transfers between businesses and clients. It offers a range of financial services, including also a digital wallet and a debit card. And, as spoken before, it provides a platform for businesses to accept payments and manage transactions securely. So it's a fintech company, but very, very scaled up and with a large market cap. I ran some fundamental analysis on it, and I have to say, it looks really good. It's nearly perfect. I believe it has an existing moat and a competitive advantage because of its size, its brand, and its current user base, which is very loyal and has low chance of leaving PayPal for another competitor such as Adyen. It has very, very big pricing power since it's one of the fintechs that has the highest commissions out there, and the users are still sticking with it. It has organic revenue growth and organic free cash flow growth, having an incredibly consistent free cash flow generation. It has a solid balance sheet, has no liability risk as it is able to meet its interest payments, even with the current increases in interest rates, and it does share buybacks. It doesn't provide dividends, but it does consistent share buybacks, which is good in a stock. But is there a problem in the long-term analysis? Well, I did an quick analysis on the growth potential. It does follow secular trends with everyone nowadays moving up to digital payments, digital transactions, and sticking away from traditional banks, going more into solutions such as Revolut or even PayPal. However, there are two things that I think are worrying investors right now. The first one being a slowing growth, and the second one being shrinking margins. The most worrying one over here, I would say, is the shrinking margins, because this is a sign of increased competition. The slowing growth one, I think it makes common sense. This stock has been growing so much over the past few years, and since it's becoming a lot larger, obtaining a 10% growth when you're valued at 500 million, it's a lot easier than obtaining a 10% growth when you're valued at $50 billion. So that makes sense. The shrinking margins, though, it's a bit worrisome. In the valuation analysis, however, I don't think the shrinking margins make sense for this steep decline in prices. As we spoke about, the PE ratio went from 80 all the way down to 20 or even lower in the span of 3 years. And its free cash flow yield right now, it's at 8.03%, which is incredibly attractive for a stock. This is a method used by Terry Smith to just kind of see if a stock is trading at an attractive PE ratio, if the free cash flow yield, which is the free cash flow generated by a company over its market cap, if the free cash flow yield is higher than the long-term inflation rate for the US, which we stated at 3%, a bit conservative, then it is attractive. And this is trading at over 2.5 times the long-term inflation rate. So it is dirt cheap right now. But there is a reason for it being dirt cheap right now. Running a financial analysis with the ratios I like to run, the majority of them seemed very fine. You can see the interest cover is 12 times. If this number is higher than 10, it means the company is in a solid position to cover its interest payments. Especially right now, this is important. Now that interest rates are increasing, a lot of companies are having to pay a lot more interest. So if this number is over 10, it means that the company is in a stable position regarding its liabilities. Has a cash conversion of over 100%, which is 157%. This is really good. It means that for all the money it earns, it is able to transfer 57% more, like 157%, into cash flows, into free cash flow, which at the end of the day, it's what us investors receive from investing in a company. So that is wonderful. Then the operating margin is at around 50% and the gross margin around 15%. The operating margin looks really healthy. The gross margin is a bit worrying. Usually you would want it to be above 15% for it to be safe, but it's around there. It's not worrying. The return on capital employed, however, is the number that worries me. It's at a 5%. And this number should be above its WACC, or its cost of capital, meaning that companies should be able to obtain a higher return in percentage-wise than what they are paying to get financing through either equity or debt. And PayPal right now is returning a lot lower than their cost of capital. This causes the stock to actually not create value for the investor, but actually destroy it. And my whole investment thesis is based around the return on capital employed. So if this number is lower than the cost of capital, which is usually around 10%, I would stick away from the companies. But here are the risks and the possible challenges that PayPal faces right now. First one is the competitor, and I put this as 90% because I believe it is the main source of risk for PayPal. Companies such as Adyen, Revolut, or other digital payment companies are growing significantly and are taking market share away from PayPal. And these are the direct reason for why PayPal's margins are decreasing. They're having to reduce their prices and their commissions in order to stay competitive. I see this as a risk. Second one is regulatory. Being affected by regulatory changes, I think it's a 40%. I think digital transactions are going to be regulated somewhat and in some time. I don't think it will be a heavy regulation. I just put it at 40% to be conservative. 70% is the meeting the growth projections. As we have seen, they are currently slowing down their growth. But I believe that the decrease in margins is going to heavily affect their growth projections and their ability to generate cash flow at the rate they were projecting. So this is why I put it at a high 70%. And then the market, I put 60%, but it's related to the competitors again. I just put it there because there are talks about us entering a recession. I don't believe so. For me, I would put this as a lower percentage. I would put this at 30 to 40%, so I wouldn't worry about the market. But the competitor one is a risk that really, really worries me about PayPal. So the investment conclusion for this, and before we move on here, remember, I'm not a financial advisor. Don't take this as advice. If you want to invest in them, go ahead. If you don't want to invest in them, then don't. I believe it is a company that has a strong competitive advantage through their brand, so a moat, and that they provide consistent cash flows which are predictable and extremely resilient. So that's amazing for the company. However, they don't have a high return on capital employed, which means that they are destroying value for the investor, in my point of view. So I believe that it is not a safe investment. Having said this, I believe it has higher risk of investing in PayPal. However, it has possible higher returns since it's trading at really, really low valuation. I think you could make some quick money here. I personally am not going to invest in it because I focus on long-term companies, but I see why some people would jump into PayPal right now. So thank you very much for watching. This has been the Cash Flow Compounder. Please join the free Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic.